If you are watching this, you likely spent the last 20 or 30 years building something substantial. You have navigated market cycles, survived the volatility of the early 2000s, and perhaps even thrived during the great financial crisis. You have reached a point where your portfolio is no longer just a collection of trades. It is a legacy. You look at your statement from a Big Four bank. The logos are familiar, the brand is centuries old, and the numbers on the screen suggest a profound level of solvency. On paper, you are secure, but I want to invite you to look beneath that surface. We often mistake the brand of the bank for the infrastructure of the bank. We assume that because the marble in the lobby is solid, the digital architecture behind our assets is equally fortified. The reality is far more sober. Behind that prestigious interface lies a sprawling, chaotic web of third-party software. Much of your financial life, your titles, your escrow data, your credit history, is no longer at the bank. It is being managed by lean, venture-backed startups and opaque software vendors that your bank has integrated into its system for the sake of efficiency. These entities hold the keys to your kingdom, yet you have likely never heard their names. Today, we are exploring the counterparty trap. We are going to look at why your bank's reliance on these external tech stacks is the single greatest threat to your long-term asset preservation. It is time to move past the illusion and analyze the systemic fragility of modern banking. To understand the gravity of this situation, we must look at the recent reporting from Bloomberg regarding the FBI's investigation into a significant hack of real estate finance technology. The headlines are focused on the immediate fallout: leaked data, stalled transactions, and the involvement of federal authorities. But for the discerning investor over 40, the hack itself is merely a symptom. The real story is the vacuum it exposed. According to the Bloomberg report, the target wasn't the bank itself, but a specialized tech vendor that services the banking industry's real estate arms. This is the vendor risk vacuum. Your bank performs rigorous due diligence on you, the client, yet their own due diligence on the software providers they allow into their inner sanctum is often superficial, a box-ticking exercise driven by the need to lower operational costs. When a vendor like this is compromised, it creates a cascading failure. It isn't just about one transaction being delayed. It's about the integrity of the data that proves you own what you own. In this specific case, the hack didn't just expose personal information. It paralyzed the movement of capital. It highlighted a systemic vulnerability. The banking industry has become an integrator rather than a fortress. They have outsourced the very plumbing of your wealth to third parties who do not share the same regulatory burden or capital requirements as the banks themselves. This isn't an isolated incident. It is the new baseline of institutional risk. We are currently living through what I call the trust paradox. For most of the 20th century, trusting your bank was a sound strategy. Banks were vertically integrated. They owned their vaults, they managed their ledgers, and they employed the people who moved the money. Security was physical and internal. In the 21st century, that strategy is not only outdated, it is dangerous. Modern banks have pivoted. They are no longer fortresses of capital. They have become shells for external software integrations. When you log into your portal to view a real estate investment or a treasury bond, you are likely looking at a wrapper. The data is being pulled via API from a third-party server, processed by a second-party cloud provider, and verified by a fourth-party compliance tool. This shift was sold to us as innovation, but for the high-net-worth individual, it is a massive expansion of counterparty risk. Every time your bank adds a new fintech partner to their stack to improve their user interface, they are adding a new potential point of failure. You are essentially being forced to trust a chain of entities you didn't sign up for. Your bank has effectively outsourced its security and your privacy to the lowest bidder or the most convenient API. This is the paradox. At the moment when we need the most institutional stability, our institutions have never been more reliant on external and proven software fragments. The assumption of safety that governed our investment decisions for the last 30 years is no longer valid. To truly appreciate the risk, let us trace the path of a single dollar in a modern real estate transaction. In the old world, the path was clear: buyer to bank, bank to seller. Today, the anatomy of that transaction is a labyrinth. When you initiate a wire, your instruction first hits a front-end UI provider. That provider sends the request to a middleware identity verification service. From there, the data moves to a cloud-based document management system, perhaps the very one the FBI is currently investigating. Then it enters a third-party escrow platform, which relies on its own set of subvendors for title searches and tax calculations. By the time that dollar actually settles, your sensitive financial data has touched a dozen different opaque entities. Each of these nodes in the stack is a black box. You don't know who their CTO is, you don't know their balance sheet, and you certainly don't know their security protocols. Yet, each one of them represents a counterparty trap. If the title software goes down, your transaction freezes. If the document provider is hacked, your identity is compromised. If the identity service has a bug, your assets could be misallocated. This is the dependency chain, a series of fragile links where the failure of the smallest, most obscure vendor can paralyze the largest institutional player. For the investor over 40, who understands that capital preservation is about minimizing variables, this level of complexity is the ultimate variable. It is a system built for speed and operational ease, not for the long-term protection of your legacy. When we look at the Bloomberg report regarding the FBI's investigation into a critical real estate finance tech vendor, the immediate reaction from the public is often a question of, who got hacked? But for the sophisticated investor, the individual who has spent 20 or 30 years building a legacy, the question is much more unsettling. How was this allowed to be a single point of failure? We are currently witnessing the institutional failure of due diligence. In the modern banking sector, risk management has largely devolved into a checklist culture. A bank's procurement team sends out a 200-question security survey to a software vendor. The vendor sales team, often incentivized by growth over robustness, checks the boxes. This is compliance theater. It prioritizes short-term operational efficiency, getting the software integrated so the bank can lower overhead over long-term technological resilience. This checklist approach fails to account for the vendor risk vacuum. Your bank might audit their direct partner, but do they audit that partner's subprocessor? Or the startup providing the API that handles your sensitive escrow data? We have reached a point of systemic tech rot where the chain of trust is so long that no one at the Big Four truly knows who is holding the keys to your data at any given moment. They have traded the fortress for a network of interconnected glass houses, betting that no one will throw a stone. The Bloomberg case study proves that the stones are already being thrown, and the glass is more fragile than we care to admit. If you are over the age of 40, you are the primary target of this systemic fragility. Why? Because you are operating under what I call the assumption of safety, a mental model built during the last 30 years of relative financial stability. You grew up in an era where the brand on the building, be it Chase, Goldman, or Citi, was a proxy for the physical security of your assets. But that world is gone. Today, those brands are essentially marketing shells for a complex stack of outsourced tech. For the established investor, the risks are not just identity theft. They are much more profound. We are talking about asset freezes during vendor maintenance events, or the silent leakage of high-net-worth data that allows for sophisticated, targeted social engineering. When a real estate tech vendor is compromised, it isn't just a glitch. It is an erosion of the private sphere that took you decades to build. The consequences for a 25-year-old with a few $1,000s in a neobank are minimal. They have time to recover. For you, a systemic failure in the settlement layer of a major real estate transaction could mean a frozen legacy at the exact moment you require liquidity. We have moved from a time where the bank was a vault to a time where the bank is a vulnerability. The Big Four are no longer fortresses. They are integrators, and they are integrating your risk without your informed consent. The path forward requires a fundamental shift in how we perceive financial security. We must move from the 20th century model of trust to the 21st century model of verification. At the horizon, we define this as the verified finance movement. Verified finance isn't about chasing the latest speculative asset. It is about utilizing technologies and protocols that allow for the independent verification of your assets without relying on your bank's opaque vendor list. It means demanding transparency in the tech stack of your wealth management. This involves looking toward protocols where the ownership of an asset, be it a bond, a piece of real estate, or a cash equivalent, is recorded on a ledger that you can verify independently of any single institution's internal software. It's about minimizing the number of third-party hands that touch your data. If your bank cannot tell you exactly which third-party software is processing your transaction and what their security protocols are, they are asking for blind trust. In an era of state-sponsored hacks and systemic vendor failures, blind trust is no longer a viable strategy for asset preservation. You must become your own chief technology officer, or at the very least, you must partner with institutions that prioritize proof over promises. Let us be sober about the decade ahead. The next 10 years of wealth management will not be defined by who has the best returns, but by who understands their tech stack as well as they understand their balance sheet. The illusion of safety provided by the Big Four is a comfort we can no longer afford. The Bloomberg investigation into real estate tech is not a one-off news story. It is a signal. It is a warning that the infrastructure of our financial lives has been outsourced to the lowest bidder, often without the oversight required to protect a lifetime of work. Your task now is to move from passive trust to active verification. Ask the difficult questions of your advisors. Look for the gaps in the counterparty chain. Seek out the tools that provide independent proof of your holdings. Capital preservation in the digital age is an active pursuit, not a dormant state. The horizon is clear for those who choose to see it. The future of finance is not trusted. it is verified. This is the only path to ensuring your legacy remains your own. On the horizon, stay analytical, stay calm, and above all, stay informed.